Hi, welcome back to Das Digital Ledger. In this video, we are going to take something that can seem quite complex on NetSuite, that is the relationship between your transactions, your general ledger, and your financial statements, and we're going to break it down step by step. We're going to look at the two most important business cycles on NetSuite, which is your Procure-to-Pay, P2P, and Order-to-Cash, your O2C. And more specifically, we're going to answer a question that comes up all the time. So when I create transactions in NetSuite, what happens to my financial statements? So by the end of this video, you will be able to connect how when you create transactions on NetSuite, how it impacts your GL, and how ultimately your income statement and your balance sheet gets impacted. Let's get started. Before we dive into P2P and order to cash, let's understand the basic flow in NetSuite. So think of it as three layers: transactions, GL, and financial statements. So let's take a look at transactions. So we can broadly categorize them into two types. So first are the transactions that represent what we are planning to do, such as your sales orders or your purchase orders. And the second one, they actually record what happens financially, such as your vendor bills, your customer invoices, your payments, and so on. Next, your GL. So when a transaction has a financial impact, so let's say, for example, your vendor bill, so NetSuite translates it into debits and credits and posts them to your chart of accounts. And finally, so depending on the account type associated to each account, NetSuite will determine where that amount will get posted. So for example, if your account type is of type assets, liabilities, or equity, it will get posted to your balance sheet. And if it is a revenue and expense account, it will get posted to your income statement. So essentially, depending on your business activity, you will create some transactions on NetSuite, which will translate to GL and which ultimately will impact your financial statement. And that's the flow we will follow throughout this video. Now, before we look at transactions, let's understand the two financial statements that we'll be using. So first, let's look at the balance sheet, which you can think of it as a snapshot. It tells you where the company stands at a specific point in time. So this is the famous accounting equations where assets equal to liabilities plus equity. And basically, your balance sheet tells you what does your company own, that is your asset, what does it owe, that is your liability, and what belongs to the owners, which is your equity. And the next part is your income statement. So this one, it tells you what happened over a period of time. So for example, how much did the company sell? What did it spend? And ultimately, did it make a profit or a loss? So the easiest way to remember is, for example, the balance sheet is where we are, and the income statement is how we got there. And this distinction will be really important when we start looking at how P2P and order-to-cash transactions affect each statement. Now, let's look briefly at the two sides of a business. So you have your company. On one side, we buy from the vendor, that's the procure-to-pay process, or P2P. And the process in NetSuite is we create a PO, we receive or we bill either way, and then we proceed with the payment. On the other side, we sell stuff to our customers, so that's the order-to-cash process. And on NetSuite, it starts with your sales orders. You can either fulfill first or invoice first, and then of course you will proceed with collecting the cash. Now, NetSuite tracks both processes and translates these business activities into accounting entries. So throughout this video, we'll follow both sides and see how each transactions impact the GL, your balance sheet, and your income statement. Let's start with the procure-to-pay process. So the first stage of the P2P cycle is purchase orders. So purchase orders, they just record our intent to buy. As we mentioned, it's not a completed financial event. So in our example, we are purchasing 10 laptops at $600 each for a total of $6,000. So at this stage, we're only telling NetSuite, hey, we are planning to buy these laptops. And because nothing has been received and we haven't billed yet, there is no accounting impact whatsoever. And because there's no GL impact, there is nothing hitting our chart of accounts and nothing hitting our income statement or balance sheet. So let's move to the next phase, which is your item receipt. So let's say we have received the 10 laptops into our inventory, and this is where things start to change financially. So NetSuite records two GL impact. First, your inventory is debited by 6,000 because we now have 6,000 worth of inventory. And second, your accrued purchases, which is your inventory receipt but not yet billed, is credited by 6,000 because we have received the goods, but we have not paid we have not received the vendor bill yet. Now, if you want to know why each account gets debited and credited, I will link some of the videos in the description box below. So now let's take a look at our chart of account. Inventory is an asset account because it's something that the company owns, whereas your accrued purchases is a liability because it represents an amount that we owe. So what does this mean for our financial statement? So income statement wise, nothing, but balance sheet. So our inventory increases by 6,000 and liability also by 6,000. And as you can see, there's no income statement impact yet because we haven't incurred any expense at this stage. So let's move on to vendor bill. So let's say we have the vendor sends us the bill for the whole $6,000. So when we enter the vendor bill on NetSuite, so NetSuite will create the following GL entries. So first it will debit our accrued purchases, and next it will credit our trade payable account. So notice something important here. Inventory doesn't change. We have already recorded inventory when we received the laptop. Now we are simply moving the liability from accrued purchases to accounts payable. Now, both of them, accrued purchases and trade payables, are liability account, and they are located onto the balance sheet. There's nothing on our income statement so far. So on our balance sheet, we have the inventory that we have received earlier. And then right now we are netting out our accrued purchases and we are transferring that liability to our AP. So basically at this point, the balance sheet is showing us that, hey, we have 6,000 worth of inventory and we owe 6,000 to our vendor. So to close the P2P process, we have the vendor payment. So when we pay our vendor, we are going to credit whatever bank account it might be, and then we're going to debit our trade payables. So looking at our chart of accounts, bank, it is an asset account, and payable, as we have seen, is a liability account. So nothing hitting our income statement so far. Why? Because the expense hasn't happened yet. We have simply settled what we owed to the vendor. So if we look at our balance sheet, we have 6,000 worth of inventory. Accrued purchases got netted out during the vendor bill creation. Right now, we are crediting our bank account by 6,000 and we are netting out our AP as well. So if we look at the P2P journey as a whole, so PO, no GL impact, receipt, debiting inventory, crediting accrued purchases, vendor bill, debiting accrued purchases, crediting our accounts payable, and vendor payment. We're debiting AP and crediting bank. So at the end of this journey, we are netting out our accrued purchases and AP. And basically what we did, we bought some stuff, add them into our inventory, and we credited our bank account by paying our vendor what we owed them. That's it. Now let's look at the other side of the business, which is order to cash. So we'll use a similar example. So our O2C start with our sales order. So let's say the customer places an order of 10 laptops at $1,000 each, with still the cost of $600 per laptop. So just like the PO we saw earlier, the sales order represents something that is expected to happen. We have received the customer order, but we haven't delivered the laptops and we haven't billed the customer yet. So at this stage, there is no GL impact whatsoever and nothing hitting our income statement nor our balance sheet. So the sales order is essentially telling NetSuite this is what our customer has ordered, nothing else. So let's move to the shipping part. So let's say we have shipped all the 10 items to our customer. Now, when we create our item fulfillment on NetSuite, there are two entries that gets generated in our GL. So first is inventory. So we are removing inventory, that's a credit. And this is where our COGS gets impacted. So the COGS, the cost of goods sold, is the cost associated with the products that we have just sold. And if we look at our chart of accounts, so inventory, as we have seen earlier, is an asset account located on our balance sheet, whereas your COGS, well, it is an expense account and it is located on your income statement. So let's take a look at our financial statement. So on the income statement, we now have $6,000 representing the cost of the laptops we have sold. And on the balance sheet, our inventory decreased by 6,000. So notice something important though. We haven't recognized the 10,000 revenue yet. We have delivered the goods, but we haven't invoiced the customer. This will come just after this. So invoice, we have sent the invoice to the customer for the whole 10,000. And this is where the revenue side of the transaction is recorded. So when we create an invoice, this is the GL impact in the backend. So first, our revenue account will get credited and our AR account will get debited. Again, if you want to know why and when each account gets debited or credited, I will add the link to those videos in the description box below. So now let's take a look at our chart of accounts. So your revenue is an income statement, thus it is located in your income. Sorry, it is an income account, thus it will be located on your income statement. Whereas your AR account, well, it is an asset and it is located on your balance sheet. So if we look at our income statement, so we have the 6,000 that we carried on from our COGS. And now we record the 10,000 revenue that we have just made. So our gross profit is now 4,000. And if we look at our balance sheet, so we have the 6,000 of revenue that we have, 6,000 of inventory that we have sold. And we have 10,000 in our AR because it will record this is what our customer now owes us compared to AP where we were owing our vendor. So to close the O2C process, we have customer payment. So let's say finally the customer pays us 10,000 and the accounting impact is straightforward. So we're going to debit our bank account. Yeah, we got some money. And we are going to credit our trade receivable account. So on the chart of accounts, what happens? So same, bank is an asset account, AO is an asset account. So at this stage, nothing on our income statement gets changed. Whereas on our balance sheet, so we have the 6,000 inventory that we have carried before. And now we are recording the $10,000 that we have received from our customer in our bank account. And our AR gets cancelled out. So basically, this payment, it converts what the customer owed us, that was stored in your accounts receivable, into your cash account. So now if we put them all together, sales order, no GL impact whatsoever. Item fulfillment, so it will increase your inventory, decrease and increase your COGS as well. customer invoice, your AR will get impacted as well as your revenue. And customer payments, this is where your AR will get cancelled out and your bank account will get debited. So at the end of the day, your AR gets netted out. And what you have done is, well, you have sold some inventory and received some of them in your bank account, and you have recorded the costs associated with selling those products. And you have also recorded the revenue that you have made from the sales of this product. So that's how a customer order ultimately flows through NetSuite and into your financial statements. So let's bring it all together. We had our P2P process where we want to buy some stuff from our vendors. We receive those items, we receive the bill, and then we pay our vendor. On the other side, we sell some stuff to our customers, we ship the item, we send them our invoice, and then we receive the customer payment. Now, throughout both of these processes, NetSuite translates business activities into GL impacts and ultimately where it flows into your balance sheet or income statement. So whenever you're looking at the transactions in NetSuite, remember three things. First, what happened? Second, what was the GL impact? And third, where does it appear on our financial statements? So once you know this, accounting in NetSuite becomes much easier to follow. So that's it for today. If you've liked this content, follow Das Digital Ledger, and I'll see you in the next one. Thank you.